That is our market report. Now let's move on to our financial 15. So I am going to share my screen again, and I'm going to try not to block my screen with that little picture on the right. But give me a second to adjust. So if you're just joining us for the Financial 15, this is the last 15 minutes or so of our weekly webinar, where we talk for about 45 minutes or so about IRA updates, tax efficient distribution updates from our friends and my mentor, Ed Slott, and his group. We go over the markets and how the markets performed last week and some thoughts about how to position yourself going forward, or analyst reports going forward. And by the way, let me just talk about that because I didn't mention it today, but remember the 3 pillars of investing. And if you want to review the video, you can find it on our website at attleborowealth.com under investing. The way to tackle all these things is, of course, first have your financial plan, and your financial plan should drive how your allocations are. And how you're invested is what I'm saying, but it has to be more in depth than that. You need a process of investing that is, first of all, is going to protect what you need in the long run, in the short term, but make sure that your funds are available when you need them early in retirement, but also for growth later on. So using the principles of asset allocation, principal protection, and account segmentation are 3 important tools to this, and I believe the answer to this issue. So regardless of what's going on out there in the world and all the static and all the mess, and is the economy slow enough? Is it still too hot? What's the Fed going to do? That's all good information if you're into that, but it really doesn't matter, right? Because the markets are going to have good times and bad times, and sometimes they're going to be worse. And my thought that it's probably going to be bad or difficult for the next year, 3 years, maybe even 5 years. But the answer to this is be driven, but have your allocations and your investment decisions driven by a plan, and make sure that it's not just based on one simple part of a good investment strategy, and that is asset allocation, which is how most people manage their investments, but also have asset allocation, principal protection, and account segmentation. And with those 3 pillars, you'll have a good foundation. We want to build that good foundation. Okay, so the Financial 15. So really, here we are now in the Financial 15, and this is the last 15 minutes or so of our weekly webinar, where we talk about all those things I just talked about. So if you're just joining us for the Financial 15 on our YouTube channel, please hit the like, subscribe, and notify button, and you surely won't miss a video that's posted. And if you're subscribed, then you can ask questions and chat along the way. So, okay. So we're going to talk today. We're going to talk about Roth conversion rules. Now, I'm going to be honest with you. There aren't many rules, but you have to know the ones that there are. I talk about in class, and you may have heard my webinar with Dave McKnight, where I said Roth conversions are a real gift, because we can decide how we're going to pay tax on our future, our money that we've pledged to the IRS. Don't forget, you've heard me say, you've heard many of us say, you have a business partnership with the IRS in your retirement, and that can change at any time, and it's not going to change for the better for you. So the IRS, if you think that you own 80% of your retirement account right now, let's say you're fortunate enough to have $1 million in your IRA, and you think that you own $1 million of that money, I'm sorry to tell you, you're sadly mistaken. You're lucky if you own 80% of that, or $800,000 today. That is money that you can spend. Of course, it's in your name, but it's also in Uncle Sam's name, because you've promised to pay them later. So if you wanted to spend that $1 million, whether it's over time or immediately, you must send Uncle Sam their required portion. And today that might be 20% for you. That's an example. Very, very soon, it's likely to be 25, 30, 35, 40, 45, or more. So the Roth conversion allows us to take the pledged money that we've pledged to the IRS in the traditional IRAs, traditional 401ks, traditional tax-deferred accounts or plans, and move them to something that you're never going to pay tax on again. So Ed Slott says, you want to shift things from forever taxed to never taxed. That's correct, but I like to say never taxed again, because you do have, we're going to talk about that. You do have to pay tax on those conversions. But the Roth conversion gift that Congress and the IRS has given us says that you can decide how much money you want to move from your traditional bucket to your tax-free bucket, or to the Roth, and the only decision is how much tax you want to pay, right? So you can convert $1,000 or $1 million, anywhere in between. It's up to you. The only decision is what tax you want, how much tax you want to pay. So you get to choose how much tax you're going to pay on that money today. There's going to be a point when you're not going to have a choice. You're going to end up paying a tax rate, and it's probably going to be one that's significantly higher than you're planning for, because we have these things called required minimum distributions, and required minimum distributions at whatever age that's going to be for you, 73, 75, whatever the age that's going to be for you. The IRS is going to tell you exactly how much you have to take out of your IRA. And if you don't, you have penalties, as you've heard about in our weekly webinar before this. And you're going to pay whatever tax rate it is at the time. And as I said, within 10 years, it's likely to be much higher than it is today. So let's talk about first conversions versus contributions. So this gets mixed up a lot. Today, we're talking about conversions. A conversion is simply, here are your buckets. You got your taxable bucket. You've got your tax-deferred bucket. And without going into my charts here, you've got your tax-free or tax advantage bucket. So a conversion is you take dollars from here, whatever dollars you'd like, and you move it over here. So maybe if you've got $4 signs, you move $1 sign over, and maybe you do that over the next 10 years, right? And you figure out how much that you want to convert every year. Well, folks, that is a conversion. Technically, it's a distribution from your traditional plan, your IRA or retirement plan, that the IRS allows you to deposit into the Roth IRA as a conversion that doesn't follow the same contribution rules. So conversions are different from contributions, and people get, they get mixed up about this. So let's be clear as possible what the differences are. So we're talking about conversions. It's moving money from your traditional accounts. And this is where, if you're listening, I'm drawing on the whiteboard. It may make sense to watch the video so you can see exactly what I'm doing. I'm more of a visual learner and therefore a visual presenter. So that's a conversion, moving money from the tax-deferred bucket here to the tax-advantaged or tax-free bucket. Now, a contribution would be moving money from either maybe the taxable bucket. Let's say you wanted to take some of your money here and move it into the Roth via a Roth contribution. This is a contribution. It could come from your stock and bond portfolio. You'd have to liquidate before you move it over. It could come from your cash accounts, and you're limited on how much you can contribute. Again, you're not limited on how much you can convert up here. The conversion when you're crossing that bridge over to here, but you're limited. You've got some really strong limitations on contributions, and this is where people get mixed up. Even CPAs sometimes. I've had CPAs call me and say, you've over converted for a client. The conversion limit was $7,000 and you did $40,000. So, oh my gosh, we have a big problem. Well, they're incorrect. I'm fixing this so you can see this better. They're incorrect. They're talking about contributions, not conversions, because there are some contribution limits. So remember, we're going to talk about these contribution limits up here just to get it out of the way. Here are the contribution limits. So I'm sharing with you the chart that you can download from our website, attleborowealth.com. You go to the slot corner. These charts are available there. So we have in 2023 levels, your maximum contribution is $6,500 into a Roth IRA. And if you're over 50, you can contribute another $1,000 for a level or for a contribution of $7,500. So that's each individual. And even if your one spouse is working and one is not, you can do a spousal contribution and you can contribute up to $15,000. But that is a contribution. So you can see the difference between a contribution. I do see a question. I'll come back to that. The contribution is very narrow. There's really tight guardrails on a contribution. They say only $7,500 if you're over 50, $6,500 if you're under 50, and then the guardrails get tighter. The guardrails also say, well, wait a minute. If you make too much money, we have these phase-out levels for contributions. In 2023, if you're a married couple and your modified adjusted gross income is above $218,000, then there's less and less and less that you can contribute to the Roth IRA. If it goes above $228,000, you can't contribute anything to a Roth IRA. And that's contribute. And of course, that's worse, right, for a single filer, because everything's a little worse for a single filer. So those phase-out levels are $138,000 compared, and you completely get shut out of the Roth IRA if you make over $153,000 in modified adjusted gross income. Now, yes, you can do a backdoor Roth contribution. That is more of a complex strategy. You may be able to do that, but that's something you'd want to write into us about. And I think I did a video about that some time ago, so you could probably find that as well. But you also must have earned income to be able to do a contribution. You must have earned income. And it must be over the amount that you're contributing. So we not only have, let's make this a little smaller so you can see both of them. So you not only have a limit here, that says limit, that your contribution limit. So you have a contribution limit. You also have an income limit. You can't make too much, can't contribute much, can't contribute too much. You can't make too much. But you've got to make something. Yeah, so you have to earn income. You can't make too much, and you have these limits, income limit. So contributions are fine. You should be contributing if you can, if it makes sense for you. But there are limits to it. Now, again, these are contributions. You see nothing about conversions. Conversions are wide open. This is why I refer to them as a gift. Conversions are an absolute gift from the IRS or Congress. Now, I think Dave McKnight during our webinar said, let's not give them too much credit, but I want to give them credit where the credit's due, because there are let's just do this here. So again, contributions, big difference, must have income, but not too much income. And if you meet these two requirements, then we have limits. Okay, how about conversions? No income limits or requirements. Doesn't matter if you have income or not. And if you do have income, you can make as much money as you can. If you make $1 million a year or $100 million a year, you can still do conversions. And you can do as much or as little as you'd like. You can do $1,000. You can do $1 million in any year and anywhere in between. Anywhere in between. So conversions are wide open. The only determining factor is how much tax you're willing to pay. There are a couple really small rules here. Well, you must have an IRA. So here are the rules. You must have an IRA. It's pretty simple. You've got to have money in this tax-deferred bucket here to be able to convert over to here. Really simple, not that hard. So you must have an IRA. You must pay tax on that contribution. There's going to be a tax bill payment. I've got a note here, timing of payment. That tax, you're either going to do that via withholding. That's just like with your paycheck, when you earned a paycheck, and let's say your paycheck was $1,000, and the company or the payroll company sent $200. If your tax rate is 20%, send $200 to the IRS, and you got $800 in your bank account. That's withholding. You can do the same thing with the Roth conversion. So you can either do it via withholding, or if you're deciding to pay, which many people do, if you're deciding to pay your tax money out of the taxable bucket here, that's not via withholding. Withholding is when you decide to pay the money from your tax-deferred bucket during the conversion process. So for instance, let's just make this a little cleaner. Let me explain withholding. Withholding. If you're using withholding for your conversions, you're going from your tax deferred bucket to your tax free or tax advantage bucket, and let's just say you're converting $100,000. So that $100,000 gets converted. $20,000 in this example. It's only this example. Your tax rate's going to be different. $20,000 via withholding goes to the IRS. And then $80,000 is left here in the tax-free, Roth bucket. Make sense? I hope that makes sense. That's withholding, and that's one way to do it. And if you're withholding, doing your conversions, timing isn't an issue with the IRS. They consider it on the books as of the first of the year. But if you're doing it from if you're paying tax out of pocket, or from taxable bucket, your taxable bucket, it's a little different. So again, here are your three buckets. So you've got your taxable, your tax deferred, tax free or tax advantaged. Now let's assume you're doing that same conversion, right? $100,000. And instead of withholding, you've got plenty of money over here. You've determined via your plan that you can pay your money out of the taxable bucket. You say, all right, I recognize that there's going to be $20,000 due. That's $100,000. You can't really see it with that, but that's $100,000 right there. There's going to be $20,000 in this example. There's going to be $20,000 due to the IRS and tax. I don't want to do this. I don't want to withhold it. I want my money. I want my $100,000 to end up in this bucket here and have that grow tax-free in the future. I'm going to pay my tax out of the taxable bucket. So you're going to pay $20,000 in tax in this example right to the IRS out of that bucket. That makes good mathematical sense for a lot of people who have enough money in this bucket. So that's option number one, is withholding, and in no order of preference, just depends on you. And option number two is paying it out of pocket or paying out of your taxable bucket. Now, the timing on that, though, is you should generally, in my opinion, don't wait until the tax filing deadline. If you did a conversion in June of last year and you said, I'm going to pay it out of the taxable bucket, but I'm going to wait to pay my tax until April 18th of 2023 because that's when my taxes are due, you're likely going to get a penalty from the IRS because the IRS likes to have these done in the quarter for the quarterly payment in the quarter that it was done. I hope that makes sense. So if it was done in June of last year, your payment should be in September, right? Is that when it was? September. I'm not even going to write that. The following quarter, right? So for your quarterly payment. So it should be done for the quarter payment. So if you owe that $20,000, you should pay it as a quarterly estimated payment following the conversion date. I hope that makes sense. That's the way I recommend to do it, so you avoid the possibility of tax. So that's let's see, that is timing of payment. Only traditional IRAs can be converted. No taxable accounts. You can't take money from your taxable account. I get asked this all the time. You can't take money from your taxable account. If you got $1 million in your taxable account, you can't convert it to a Roth. You can make contributions if you're able to, following all the rules I talked about with contributions. There's lots of rules with contributions. But you can't make a conversion of a taxable account. So now, no taxable account. No inherited IRAs. So if you have $1 million in an inherited IRA, you can't convert that. That's a lot. Most people don't have that amount in their inherited IRAs, but maybe they do. We're going to see more and more of those actually, but inherited IRAs cannot be converted. So that is a key planning point when you're talking about leaving funds to your heirs, because you've got to realize that if you're following this tax efficient paradigm, your eyes have now been awoken. You want to become tax efficient, and you also don't want to pass on a tax burden to your children. Don't wait, because if your kids or whomever you're leaving this money to, other than if they're an eligible designated beneficiary or a spouse, certainly. But if you're passing it to a non-eligible designated beneficiary or spouse, even an eligible designated beneficiary, if you're passing it to anybody other than a spouse, they will not be able to convert those funds. So you won't be able to convert it, and they won't be able to convert it. So no inherited IRAs can be converted. Conversions must be done by December 31st. I get asked this a lot. Well, I can contribute up until April 18th for a 2022 Roth contribution. Can I do a conversion for last year? No, you can't. It must be done by the end of the year. And don't wait until 12/31, or it's likely not to get done. Most custodians, like we custody with Charles Schwab presently, those, I think they had to be done by November 15th, or maybe it was December 1st. But you don't want to mess around with it. So then we have, let's just erase that so we can read this. We have taxation and timing, and I have the art of the conversion. So there certainly is an art to it. So what we want to look at, and we're going to go to follow me along here to the tax planning table. So this orange table, again, you can find on our website, attleboroughwealth.com. We still have the 2022 tables up. And actually, I don't think we're going to update them until the new website is done, which I hope is any day now. I think I have too many here, but here's our tax rates. 22, 24, 32, 35, and 37. So the art of the conversion kind of looks like this. If we have single filers over here, and if we have married filing jointly filers over here, you can see, follow along with me, I'm over here now, that the top of the 24% bracket allows us to go for a married filer to $364,200 this year. That is in taxable income. So that's taxable income. That's not adjusted gross income. That's not modified adjusted gross income. That's taxable income. For single filers, that is $182,100. That's the top of the 24 bracket. Let's talk about the top of the 22% bracket. For single filers, that's $95,375. These are adjusted every year for inflation. So if you're watching this a year from now, these numbers are going to be different. And now for married filers, the taxable income bracket starts tops out for at the 22% bracket at $190,750. And let's just, for good measure, let's go to the top of the 22. I'm sorry, the bottom of the 22. So for married filers, that is $89,450. And for single filers, it is $44,726. So I'm giving you this because, again, there are two things to consider. Well, two major considerations. One is, how much tax? How much tax am I going to pay on this conversion amount? So if your earnings, let's say your earnings take you to here. So you've topped out to the top of the 22% bracket. I'm just going to change my color here to make it a little easier to see. We'll make it green like money. Earnings take you up to here. Now you've topped to the top of the 22% bracket. And you say, okay, I'd like to do a conversion amount. And I'm thinking about doing $100,000. So that takes you to $290,000. So that might take you right about here. So what you figured out is that for about another 2% in tax, you can start converting your money. And maybe even, you're below the 22, but let's just assume you're still working and you're making a decent income. You're making a nice income. And you're in the 22% bracket. Well, we want to fill that up. But you might also want to fill up at least some of this 24% bracket. And for us, we would likely, depending on how much money you have, actually, to convert, we might want to fill that up all the way to the top. We don't always do that, But we see folks with a lot of money in IRAs, so we often, most of the time, like to fill that up to the top of the 24% bracket. Because also just for that 2%, you get a lot more room in there. So that's part of the art of the conversion process, and where we sit and we look at the best way to convert. And when I say the best way to convert, then it's the how much money we're pushing into the tax bracket. Sometimes it makes sense to go into the 32% bracket, but I'm going to tell you that's rare. A lot of people can do what they need to do down here without increasing, another 6%. Sometimes people have to go up even higher. That's a very rare circumstance, but sometimes it happens. We see folks with, again, a lot of millions and millions of dollars to convert from their traditional IRA to their Roth IRAs, and sometimes you've got to be aggressive. So, $364,000 can take us a long way for most folks. Now, if you're single, it's not as it's tougher, right? So, if you're making $190,000 a year and you're single, you're already up here. So it makes it much more challenging to just take advantage of that 24% bracket. Then you got to figure how long you're going to be in the 32% bracket. How if it's going to be for the next 2 years, it might make sense just to wait. If it's for the next 10 years, maybe you have to push through it. Maybe the math makes sense on it. But this is why I often talk about don't wait, because the difference between married filing jointly and single is devastating from a planning and conversion point of view. Because you could see that, if you have $2 million combined between you and your spouse, and one of you passes, well, you still have $2 million, because the one spouse is going to leave their $1 million, and assume as half to the other, and you're going to have a lot less room to convert, and you're going to hit these higher marginal tax rates much, much sooner. So that's kind of the art of conversion when it comes to tax payments. So now let's talk about the timing of it. So the timing is, people ask me this all the time: are there times when the markets are down where it makes sense to convert now, right away? And yeah, the answer is yeah. There's been many times. 2020 is a really good example. When the market fell dramatically, we did a lot of conversions in the middle of the year instead of waiting until the end of the year. We do most of our conversions in the last quarter of the year, starting around early September. But there are times when I'll say, hey, the markets are significantly down. Let's convert. And why would we do that? And last year we did it too, but we only did a portion because I didn't know where it was going. Let's use these buckets again. We have your tax deferred and your tax free and your tax advantaged. And let's use that same example of $100,000. So we set out in 2023 with $100,000 that we want to convert. But hey, the market falls 20% in May. That's not a prediction. That's just using an example. So if the market, if it's all affected, this $100,000 is all affected by that market, and it drops 100 or 20%. Well, that portion, right, that 20% drop takes our $100,000 that we wanted to convert down to $80,000. Well, it might be a good time to convert that $80,000 over to your Roth IRA, or I would say even still convert the $100,000 if it makes sense. And actually use that. Let's use that. If you still say, okay, I'm going to convert that $100,000, and let's move that $100,000 over to the Roth. Now, I know the markets are going to recover at some point as long as we're properly allocated and we're following our plan and we've got it structured correctly. Well, now if this $100,000 comes back and we get that 20% growth back, well, now you've grown that $100,000 to $120,000 inside of that Roth. So now you've got $120,000 worth of Roth that you've only paid $100,000 on tax on that $100,000. So that's the timing part of it sometimes. Does that make sense? So that's timing. So sometimes when the markets are down, it makes sense. Timing. It's probably very difficult to read. All right, what else do we have here? Oh, pay attention to other phantom taxes. IRMA, income-related monthly adjustment amounts. It's not just all about tax. Sometimes it makes sense to cool the conversion amount because of this IRMA. You have to do a side-by-side comparison, and you have to make a determination. Does it make sense for me to pay IRMA now and pay a little steeper rates? So we're going to be paying less in the future, kind of like your tax. Tax on Social Security, the conversion amounts could certainly cause your Social Security to be taxed during the time that you're doing your Roth conversion. So you've got to be aware of that. Many people, again, it makes sense. You just opt to have that Social Security taxed if you're collecting Social Security and you can't delay it, or it doesn't make sense to delay it. But you've got to be aware of it. You got to be aware of these phantom taxes and make sure it still makes sense. Tax credits. You have tax credits that could disappear if you're doing Roth conversions because you're making too much money. A really good example is a electric vehicle credit. So electric vehicle credits can be up to $7,500, but they can completely go away given a modified adjusted gross income number, and conversion amounts push up that modified adjusted gross income. And here's a little bonus here. So that's IRMA, Social Security tax, and tax credits. There are other phantom taxes that you're going to want to keep an eye on, but there are three of the big ones. Here's just a side note, because I get this question. Roth conversions don't affect Roth contribution phase outs. So back to this table here. So remember these phase outs, 218,000 to 208,000 or 228,000 to 18. So let's say your modified adjusted gross income is $118,000. This is an example. And you say, well, I'm going to convert $100,000 into my Roth IRA. So from my traditional IRA to my Roth IRA, I'm going to move or convert $100,000. Well, now, rightfully, your modified adjusted gross income is going to be $218,000. And you might say, oh, I did. Yeah. Oh, I'm starting to enter that phase out level. And let's make it a little worse. Let's say this is $128,000. Now that takes you to $228,000. You make too much money to do a Roth conversion at all. And you might say, oh, geez, well, that conversion messed me up. I can't make a contribution. That's not true. The IRS excludes this, not for your taxable income, not for your modified adjusted gross income, but for Roth contributions only. So in this case, you can still do a full contribution. Please don't let that stop you. That's potentially another $7,500 for you, another $7,500 for your spouse. And we talked about the 5-year rule. Pay attention to the 5-year rule. The 5-year rule says that you've got to have any Roth IRA, if you're over 59 and a half, any Roth IRA for more than 5 years for your earnings to come out tax-free. Okay, so they are the Roth conversion rules. I know there's a lot going on here, but just remember that there really aren't many rules. The guardrails are pretty wide. So you don't have to have earned income. There are no income restrictions or limitations. You can convert or as little or as much as you'd like. And the only considerations are how much tax you're going to pay, how it's going to affect your other items such as IRMA, Social Security tax, and tax credits. But that's the art of it, right? How to determine that amount where it's going to be significantly beneficial in the future. And I will tell you that tax efficient planning can have huge impacts and life-changing impact on people. I see commonly millions of dollars of difference to individuals when we show them the before and after comparison of if you continue working in the tax-deferred paradigm where you won't owe Uncle Sam money at the I don't know tax rate that comes out of there, out of that tax-deferred bucket, compared to managing and choosing the tax rate you pay. Because what I showed you here was, where'd my tax table go? What I showed you here was when we're working through this calculation of how much conversion amount you should do, what you're doing is you're choosing your tax rate. You're choosing the tax rate you're going to pay on this money, which you are going to give up that right at some point in your future because the IRS is going to force you to pay tax at a certain rate and will force you to take a certain amount out. So what you're doing right now is a choice, right? So you're choosing tax rate. So where was I? But that's the, that's the gift of the Roth conversion. So not many rules, nuances for sure. You don't want to take this on yourself. And in my opinion, if you have questions, if you'd like to talk about how we can help you, you can reach out to questions@attleborowealth.com. That's questions@attleborowealth.com. Continue to listen to these webinars or watch these webinars and educate yourself. It's always great seeing everybody. I'm going to look at these questions just for a moment. And if you want to stay with me, you can, but it's 11 o'clock. Let's see. Umberto. Hey, Umberto, good to see you. What's the difference between conversions versus rollovers? Great question. So a rollover is is when you're taking a IRA and you're moving it to another IRA, or you're taking a distribution from a retirement plan and you're moving it to an IRA. That is, taking money from either a already established IRA and moving it to a similar type of tax-deferred entity. So commonly used is taking, my IRA at Vanguard and rolling it into an IRA at Attleboro Wealth Management. We custody with Charles Schwab, so it would be, a rollover from I think I said Vanguard to Charles Schwab. Or to Attleboro Wealth Management. Or I'm rolling over my 401k from my plan sponsor at Fidelity to Attleboro Wealth Management IRA. So that's a rollover, and that's tax-free as long as it's done correctly, which, it is, you can do it. You can do it incorrectly, but it's not if you work with us, because we know the rules. But as long as it's done correctly, that's a rollover. There's not a taxable event. So it's just replacing funds from one traditional IRA or traditional 401k or 403b or other retirement plan for another like traditional IRA or 401k. You can roll over a 401k plan to another 401k plan or other retirement plan. Good question, Umberto. Good to see you. Jerry's asking about, hi Jerry, I hope you're doing well. Can you illustrate the impact of the standard deduction on modified adjusted gross income for married couples? So the standard deduction is a tax deduction that anyone gets if you don't itemize and you don't go over the standard deduction, which today is $30,000. I'd have to do a little bit of math with that. It's $27,700, but if you're over 65, it's another $3,000. So that'd be $30. That's easy math. $30,700 today, and you can find that. Let me just share one more time my screen. You can find that on this orange sheet right here. Right here under standard deduction. So if you're married, $27,700. If you're single, of course, you get less, $13,850. Had a household is $20,800. And if you're married filing jointly and you're over 65 or blind, you get $1,500. If you're over 65 and blind, you get a little bit more. And if you're single filer and you're over 65, you get another $1,850 on top of this standard deduction. So it reduces your income, therefore it reduces your modified adjusted gross income. I hope that's what Jerry's looking for. All right, a couple more. Oh, Debbie says, "You're awesome!" Exclamation point. Thank you for the information! Exclamation point. Well, thank you, Debbie. That was very nice. Doug says, "Thanks again, Mark. Thumbs up. I appreciate that." And now Debbie asks, "Does the Roth conversion 5-year rule apply to me if I'm 66 years old?" Yes, it applies to you, but it is relatively simple, Debbie. If you've had any Roth IRA for more than 5 years, even if it only had $100 in it, then you've met your 5-year requirement. If you haven't, if your Roth IRA is less than 5 years old, don't worry too much, because the IRS has these ordering rules. So it says that if you have to take distributions out of your IRA, what they first they pin any distributions that first come out as contributions. So, for example, if you have $100,000 in your Roth IRA and you've let's break it down. You've contributed $40,000. You converted $40,000 for a total of $80,000, and then you have $20,000 worth of growth in that. So the people get caught up in I'm going to have to pay tax on that $20,000, but you would have to you'd have to spend out draw out that first $40,000, or, no matter how you take it, the IRS considers it this way. You don't have to designate it. The IRS says the first $40,000 that comes out of there is considered contributions. The second $40,000 in this example is considered conversions. And then last is any growth. So you could take, if you're under 5 years and you needed that money, you could take $80,000 out in this example, and then still leave that $20,000 in there to continue to grow. The problem is with taking money out of Roth IRAs is you can't get it back in there easily, right? Because if you're not working, you can't do contributions. You can't do conversions. If you can do conversions, but you can't convert that money that you've taken out and used for something. You can't convert that money back. So really, really great questions. That is all for today, folks. It's a little past 11. I appreciate those of you who stayed with me. And those of you who are going to watch later, please remember to hit the subscribe notification and like button on the YouTube page. And I'd love to hear a comment from you. I'd love to get a like on the video as well, if you like it only. And otherwise, we'll see you next week. Take care and have a great week.